Hey everyone, welcome to the final bar. On Monday, we love to hit the market from the three main directions: top-down macro, bottom-up stock selection, and then sector rotation right in the middle. The S&P resilient today with the FANG man stocks, the FANG trade certainly driving the way higher. A lot of those names up multiple percents, with consumer discretionary communication services leading the way higher. The S&P finishing toward the upper end of the range around 3180 certainly suggests there's room to retest the June highs, if not further. So we're going to talk today about how that balances with the bearish divergences we're seeing in a lot of those big cap names as well. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to make sense of these markets together, look at the trends through a technical behavioral perspective, connect the short term of what we're seeing today with the long term and how it's evolved. And I think today we're seeing a return to resilience. We sort of sold off into the long holiday weekend. I think Thursday of last week sort of left at least me with a bitter taste of sorts in terms of, are we breaking out or not? Because we've broken out of the short-term pennant on the S&P 500, then we sort of sell off into the close. If you were looking for an answer, I think today you sort of got it. The S&P finishing in a position of strength. So we're going to talk about, in particular, when we get to shifting stocks later in the show, we're going to talk about some of those individual charts, that FANG trade, and how it's really continued to emerge, strengthened, and continues to push the market higher, but not all stocks are participating. And that's what, if there's anything that concerns me, I think that's sort of where I'm at. Now, we have a lot of great guests coming up today. It's going to be just me driving through the markets. Tomorrow, I'll be joined by Clive Lambert from Futures Techs in London. On Wednesday, Landon Whaley from Whaley Capital Management. On Thursday, Javed Mirza from Canaccord Genuity based in Toronto. Next week is our special event, the entire week, called Charting the Second Half, a mid-year market perspective. We're going to stock charts the entire team, all of our contributors, a number of guests, presenters, guest hosts, guest speakers are going to join us on Stock Charts TV for the entire week, focusing on where the second half of the year may be headed from a technical perspective. And then also at the end of that week on Saturday, July 18th, that's at noon Eastern, 9 o'clock Pacific AM. We're going to do a live market forecast panel. I'll be moderating a fantastic conversation with a group of strategists, and it will be an interactive presentation. So you'll be able to ask questions live of the panelists, and we'll have a really good discussion as a group about where we see things headed. So check out the week of July 13th. Make sure you focus in on Stock Charts TV that week. So let's look at the markets here together. As I've alluded to, today's certainly finishing stronger. And again, we don't get a ton into the reasons as to why these things are happening, because for me, my expertise is in the charts. I found that regardless of what the reasons are, the charts will reflect where people are at. And my goal is to get inside all the heads of all the other investors. It's not to figure out what an event is going to do and how it may be causing things to happen. The reasons why some of these trends emerge in a lot of ways are irrelevant as a technical analyst. The goal is just focusing on the trends and how they evolve. Now, having said that, I would encourage all of you as well-rounded investors to take what we work on in this show, relate it to all the things you're reading, all the things you're seeing, your own impressions about the macroeconomic environment, geopolitical forces, the election year, all of those sorts of things. That's all important as an investor. We're just going to focus on what's key here. So having said that, certainly news out of China this over the weekend talking about them supporting the market and essentially providing the same sort of buying power that I think we've seen with the Federal Reserve here in the U.S. has certainly caused the Chinese ETFs to accelerate to the upside. The KBA, which is the China A-shares ETF, up over 10.5% today. The FXI up 9.5%, the MCHI up 7.2%. So there are a number of ways to play China based on ETFs, and it goes from the Hong Kong ETF, EWH, all the way to the KB up, and they're up at varying degrees, but all up pretty significantly. And if you look at the charts, you'll see they've all accelerated very quickly to the upside. And I think a lot of that sort of faded into the market that we've seen here in the U.S. today, which is sort of buying into that central bank able to provide whatever stimulus we need to push stocks higher. So the S&P finishing just about 3180, which is near highs of the day, which is a pretty decent up move. That's over 1.5% higher. Interesting to note, mid caps and small caps up, but up a little less. They're both up about 1%. So this is certainly driven by the the FANG trade, the FANG man trade. You can see the Nasdaq 100 up 2.5% today. Let's look at some other markets very quickly, and then we'll get back to stocks. Yields actually up a little bit. The bond market really opened pretty far down. The TLT ended up finishing about 0.4% lower, so recovered through the course of the day. But overall, this was definitely stocks over bonds today. Commodities pretty much across the board higher, with the USO, the oil ETF up 0.7%, gold up 0.6%. So this was not just a risk on with stocks. And again, I always cringe a little bit when people talk about stocks going up. So how can gold go higher if stocks going higher? Forget that. Focus on the charts, focus on the trends, and you will see days like today when stocks and gold can go up together. That has happened plenty of times. There's no reason why that cannot continue to happen over time as well. Let's look at a daily chart of the S&P and try to make sense of what we're seeing here. So, on Thursday, at the end of last week, what we focused on was that 3150 level, which is that resistance from mid-June, right? So we had the gap down, making that island reversal pattern. First to second week in June, we moved back down to the 200-day moving average. Then we established 3150 as a key resistance level. I thought it was really noteworthy on Thursday that we sort of hit that level, and that's kind of where the uptrend ended. We actually sold off into the close. Today was certainly more follow through to the upside, eclipsing 3150. I think that means we're heading back to 3230. 3240 or so. That's the high from the first week in June. That's now the last line of defense for bears. I think when that is eclipsed, I think you have to expect a return to 3400 or near that amount. But certainly, things leaning more to the upside. This now looks more like a pennant pattern, which was a consolidation pattern after a big run higher. That, along with this bull flag pattern, both measures pretty high, depending on how you measure, which is basically the trend going into the pattern. You project that to the trend after. Using those two patterns, that gives you an upside objective anywhere from 3,400 to 3,600 on the S&P 500. Now, that does not mean we get there immediately. These patterns are just meant to, suggest, and that's just a general rule of what tends to happen. This sort of pattern, this bull flag from 2 months ago, tends to be about halfway through a major move, which means it projects pretty far up there, but there can be lots of fits and starts between point A and point B. Interesting to note that the RSI never really got below 45. That's about where it bottomed out. It's back up to 60, which is really more in a bullish range altogether. Let's look at some other markets really quickly. We're going to get back to sectors and individual stocks in particular, but just to wrap up, just thinking of a recap today and what we're seeing besides the macro view we've talked about so far. Consumer discretionary, communication services both up, as well as financials, which are up almost 2% today. So led the market higher. And we're going to look a little later. Stocks like Goldman Sachs, Morgan Stanley actually holding up pretty well, which is impressive. On the downside, the only sector that was down was utilities, which was down 1.2%. Real estate, energy, staples at the lower end as well. So this is certainly a move back to offense away from defense, sort of a risk-on day. Just to finish off, in terms of industry groups, worth noting the automobiles group up the most. That was up over 10%. This is Tesla's group. And if you missed Thursday's show, Tesla has now overtaken some of these other names. DXCM had been the number one stock for a while. Tesla is actually the number one scooter rank stock, a big gap higher again today. So this stock is essentially going vertical. It's an exponential rise. Which is pretty noteworthy. But you also notice some other groups like broadline retailers up in the top 10, transportation services up in the top 10, home construction. We talked about home builders a little bit, and this group has actually started to improve. So it might be interesting to see how those individual names start to rotate. Then at the bottom, a lot of utilities, a lot of REITs, a lot of energy. The only noteworthy one I would point out is the gambling group, and again, that group has really struggled during the coronavirus fears. Recovered really well going into the first week in June, but since then has really underperformed, really struggled quite a bit. That's our market recap. Let's rotate right into our next segment, which is called sector setups. And the goal here is to focus on the 11 S&P sectors, how they're moving relative to one another, where the opportunities might be. We're going to start with the RRG graph, the relative rotation graph. If you're not familiar with this, check out Julius de Kempener's work. He hosts a show called Sector Spotlight, where he uses this methodology often. I've used this for a number of years as a way to visualize just how the sectors are rotating around the S&P, which is sort of at the crosshairs right in the middle. What's happened over the last month is essentially technology has reasserted itself as the strongest sector. And I know that for two reasons. Number one, it's furthest to the right on this visualization, which means the relative strength trend is the most positive out of all the sectors. It's also heading in the direction of improvement northeast, which means the relative strength is improving and the momentum is increasing, meaning it's accelerating on a relative basis. And this is using weekly data, so it's not just taking it off of today. This is how the trends are evolving over time. And the XLK has consistently been the furthest to the right, suggesting, again, on a relative basis, it's really where you want to be. The other sectors that are similar as possible, consumer discretionary, materials, communication services. What's interesting there is you can see like comm services turning southwest, actually turning lower. So still outperforming, but the momentum's coming off a little bit. Same with consumer discretionary. Technology is certainly the leadership area. In terms of things worth avoiding, according to this methodology, healthcare probably the most noteworthy. So it's really had been the number one sector rotating southwest. Staples, consumer staples, utilities in a similar configuration as well. Some interesting ones over here, industrials and financials. And again, it's sort of been hit or miss with these. A lot of the relative strength has fluctuated a great deal depending on, there's the stretches where defense stocks just explode. Boeing explodes to the upside and it juices the relative returns pretty quickly. But overall, certainly, nowhere near the attractiveness of some of the sectors in the on the right side here. Energy has actually rotated sort of southeast, which is kind of an unusual thing to happen over here. It'll be interesting to just sort of watch this group and see if it continues to go sort of in this direction. And the further to the right means it's continuing to outperform. It's sort of sputtering out over here on the far left side of the visualization, which just means on a relative basis, not as attractive as some of these other sectors. Let's look at the individual sector charts. We'll start with the candle glance page. And for me, this is a good way to just look at all of them together and see what themes emerge. The first thing that jumped out to me as I was looking at these over the weekend is technology and just the resilience of this. Now we can talk about performance of technology in a number of ways. The relative strength of the XLK certainly speaks to the long-term appreciation. If you look at the NASDAQ versus the Dow, for example, you'll get a similar sort of pattern. If you look at the FANG, the New York FANG Plus Index or a FANGMAN Index or most individual stocks in that group, they'll kind of look like this as well. And these are the names that sold off into the March lows, have retraced 100% and now have gone above those previous highs and are continuing to make new highs. So, not a concern, but I think the reality is just because this is going higher for me doesn't speak to overall strength. What I'm looking for, and I guess the only reason why I've been very hesitant on believing these breakouts is if and when people start getting nervous, they're going to flock to this sector, they're going to flock to these names, and I think the market will remain elevated, and I think this chart will continue to go higher, and the relative strength will certainly go higher as people rotate away from other groups and sort of park in the big defensive areas of technology. So having said that, but on its own, I think there's no denying that the chart is in an uptrend. I don't think you want to be fighting that. As we've talked about for months now, the XLK for me feels like more of a core position. That's the kind of thing you're just happy owning and trading, other things around that as a main focus. I think that makes a ton of sense here. Consumer discretionary, maybe a second group to look at. Last week was actually an interesting rally out of a swing low, and the XOY, similar to the S&P 500, has had sort of this pennant pattern, right? A nice run, and then you get the symmetrical consolidation of lower highs, higher lows. That pattern has now been broken to the upside. It's broken above 130, which was the swing high, which means you're now retesting these highs from February, which are the highs from June. So all of a sudden, this is looking like a cup and handle-like pattern. It's not ideal because cup and handle, you really don't want a big V bottom. You want more of a rounded sort of cup, like an actual cup. This is more like a cup that would fall over because it doesn't have a good base. But the idea is interesting, which is it round trips to its previous highs, now a shallower correction, and the signal on something like this is breaking to new highs. So I think, breaking a little bit further to break above the June highs really signals, along with technology that consumers telling you that we have a lot of further upside, a new 12-month relative high today for the XLY, which I think is notable as well. So consumer discretionary now number 2 in terms of leading the way higher, and pretty much at or near all-time highs as well, or long-term highs for sure. Then you get into some other sort of, muddier analyses. If you go past those, healthcare is an interesting one, right? So healthcare, you have a similar idea to what we saw with consumer discretionary, sort of this round trip, this V bottom. We're now retesting the high. In this case, around 104 would be the peak. We're now approaching those again. We haven't broken above it. If and when the XLV gets above 104, I think that's a pretty attractive chart overall. Again, what concerns me is just the relative strength has been so challenging. So really since late April, you can see how this has essentially gone sideways. It's been more range bound, while some things like technology have just continued to go to new highs. So the relative strength has improved over the last couple weeks. But again, I'd want to see a break above 104 to feel like there's further upside to be spoken of there. At this point, it feels more like it's approaching sort of long-term resistance. Now, other sectors that I think are more concerning: industrials having not quite made it above its 200-day moving average. Consumer staples testing its 200-day moving average has not gotten above it. Financials well below its 200-day. Utilities well below the 200 days. So you can see it's sort of, we've covered now the haves, and now we're in the have-nots on a relative basis, have not been as attractive, not really able to eclipse those previous highs. And so at this point, I think those are ones you sort of, lean away from until we start to reclaim the 200-day, until on something like industrials, we reclaim the high from the first week in June. But I'd be focusing more on some of these other groups that are accelerating and just able to outperform pretty consistently. Those are our sector setups for today, on Monday afternoon, early July. We're going to take a quick commercial break. Back with our next segment, Shifting Stocks. We'll see you in a minute. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks for joining us every weekday for our show. As a reminder, we love to hear from you, hear your questions, feedback on the show, guests we should have on, but in particular your questions about how to use technical analysis, how to use StockCharts.com as a platform, things you're running into through the course of your analysis. So 2 ways to get a hold of us. Email us, thefinalbar@stockcharts.com. We get a lot of great questions, and we'll answer some of them on our mailbag segment tomorrow, or on Twitter. Just tag us in a comment at FinalBarSCTV. If you're watching on YouTube, put a comment below the video, and we're happy to check those out as well. Let's get to our next segment called Shifting Stocks. So now we've talked about the broad macro overview in this market that is, continued to drift higher, and really today following through to the upside on this expectation. I feel that the Federal Reserve is going to come in, and central banks in general are supportive of stock prices and want to see them higher rather than lower. And that is a counterbalance to increasingly concerning news about coronavirus and certainly spreading here in the United States again. We talked about sector rotation and sort of the technology consumer leadership. Now let's talk about shifting stocks. Let's talk about some individual names. As a reminder, every weekend I try to go through the S&P 500 and go through those individual charts and see what themes, what patterns emerge, what sense you can get by looking at those individual charts. And then what you like to do is compare what you saw in the individual charts with the sector charts, with the broad market analysis, and then you have a pretty good holistic view about what's going on. So let's start to hit some individual names here. Start with Comcast. So, it's interesting. Communication services sort of a mixed bag, because you have things like Comcast, you have stocks like Facebook that are in the group, but you also have, Verizon and AT&T, tower names, things like that. So it's sort of this mix of stuff in this communication services sector. Comcast just jumped out to me as a chart that continues to improve. If you draw this last couple months, this 3-month period as a channel, and you use the upper end of the channel here to take the lower end of the channel here, March, April, May, June, you can see this nice uptrend, and this pullback to the 50 days, pulling back right to a trend line using the lows from the last couple months. And we're starting to appreciate a little again. So overall, even though the relative strength has not been super attractive, if you're just looking at the price, it's not bad. And in general, looking at the relative strength, don't get me wrong, very, very important. Understanding that technology is working right now, very, very important. But in general, owning stocks that have attractive price patterns, regardless of the relative strength, in general, I think you're going to do pretty well if you can stay in those kind of names, which makes Comcast feel more like a buy in the dips sort of thing, right? An uptrend. You had a bit of a pullback. The RSI remained above 40. Now starting to improve a little bit. Again, for me, the challenge with names like this, you're still below a descending 200-day moving average. The last time we tried that, the first week in June, that was it. So you'd want to see that reverse. You'd want to see it continue higher, and could be an interesting idea now. And then it breaks above 43, and that would confirm potential further upside. But it was interesting setup, pulling back on the dips there. Now I mentioned the FANG man stocks, and the chart of the New York FANG Plus Index has certainly accelerated to the upside. Amazon is one of those that certainly has driven higher, is up almost 6% today, so really rallied significantly. Interesting note here, besides the relative strength that now continues to go to new highs for much of the last month, the RSI is now extremely overbought. And generally speaking, what that means to me is you'd expect a bit of a pullback at the very least, at least one more move higher, and then you have to sort of reevaluate. And the reason why that happens, a lot of people think overbought means we pull back a little bit. Generally speaking, that's not bad. But when something's extremely overbought, an RSI above 80, I've always thought of that as a good overbought, quote unquote, which means it's such positive momentum. You'd expect a bit of a pullback, but then there's so much positive momentum, it's not just going to evaporate. And things don't go straight up and then straight down very often. It would usually have to digest those gains. It would drift a little bit further, give you a chance to get out if you're waiting for that sort of thing. So overall, speaks to long-term strength of Amazon, I would say, more than anything. Now, Facebook, obviously another one of those names that we would talk about, not as vertical as some of these other names, and not at new highs yet, but really, really close. So you can see this whole range is above the January high. We're now testing previous highs. 245 was the peak from about a week, 2 weeks ago. The previous highs around 240, we're right there. So, again, a bit more upside, a bit more follow through, and Facebook would emerge in a position of strength. The relative strength has not been as attractive as some of those other groups that have essentially, rallied further and gone up. What's interesting about the chart of Facebook, you have this bearish divergence. This is what we talked about with some of the other charts out here. Higher highs matched with successively lower highs in the RSI. We have an RSI below 60 right now. If we would top out anywhere in this area and the RSI tops out around there, that would just further validate this overextended sense, right? This sense of weakening, or trend exhaustion, even though the market's not going down, the stock's not going down yet, sort of getting to the later stages of that. And again, it's not confirmed yet. Something like that has to be confirmed with the price going down. But these are the kind of things that put it on my radar, watch list of things to be wary of. Let's talk about some other charts that have emerged, similar to Comcast. Costco is an interesting chart to me within consumer staples. A lot of the consumer staples charts, to be honest with you, look pretty weak, especially on a relative basis. Relative strength's been just so questionable. But Costco comes to mind as something that's pulled back a number of times to the 200-day moving average, has rallied off of it pretty well. Now, the concern for me is just that it's in this big sort of supply area, an area at which it's topped out historically. But overall, setting up actually pretty decently. The RSI now back above 60, which is actually a different configuration. So it could potentially be setting up. So within consumer staples, not a bad idea. Other names that come to mind, Home Depot, Lowe's are interesting. They're just not super exciting. And the challenge I have is they're breaking to swing lows on the relative strength. So even though it's not bad, it's sort of still in this consolidation. If the S&P has broken out of this consolidation, charts like Amazon breaking to new highs, you have things like Home Depot that are just not along the ride yet, right? They're sort of still consolidating. So that means the relative strength is going to rotate lower. You're not really getting paid on a relative basis to own a chart like this. So, if you would own something like this, it's not telling you to run for the exits yet. It's not a horrible negative sign. It's just not really participating. So you're not really gaining a lot from looking at this. You'd want to see it break to new highs and certainly see the relative strength reverse a little bit before I'd get excited about Home Depot. Starbucks is another one, not horrible, but again, not horrible is actually pretty bad on a relative basis right now. So you can see, even though it's held support around 71 or so, and the RSI has remained above 40, you can see the relative strength has really just been drifting lower and lower. It's near making a new 12-month relative low right now. Not quite there, but getting close to it. So, again, the concern with a chart like this is that other charts just have been performing much better. So while it's not a bad thing, I'd be wary of this until you get a bit of more emerging to the upside. Walmart, we're sort of sticking in this consumer theme. I just saw a lot of interesting charts in here. Costco sort of breaking a little bit higher in the short term. Walmart's actually continued to rotate lower. If you just, take a step back from the chart, I'm seeing a pattern of lower lows and lower highs. That's a downtrend. I'm seeing the RSI more in the bearish range, which is negative, and I'm seeing the relative strength making a new 3-month low this week. So overall, certainly suggest avoiding something like this until you get some stabilization, some indication of buying power. Just want to finish off within financials, just 2 quick charts here. Goldman Sachs is an interesting one, back above the 200-day moving average, found support at the 50-day. So it's actually setting up as a bit of a bull flag pattern of sorts. That's when you have a run, you have this parallel pullback of lower highs, lower lows. We're just at the point where we're breaking above some of these swing highs, which would be that first indication that things are getting a little better. But RSI pulled back to just above 40. So overall, it's remaining in a bullish range and up 5% today. So actually an interesting setup. Morgan Stanley, I didn't mention with Starbucks. That was one of our mindful six charts to sort of pay special attention to, see if they're able to hold support, see if they're able to break out. Morgan Stanley was another one of those, the only one in the financial sector. And overall, sort of drifting higher a little bit. It's found support at its 200-day moving average. I think that it's what's so important to watch on a chart like this. But overall, holding up pretty well and keeping pace with the market as the market's drifting higher, which I think is impressive as well. That's our segment, Shifting Stocks. And again, I look through a bunch of charts and I just try to pick out ones that I think are actionable, at interesting points, things you should pay attention to. I hope you use this as an encouragement to do your own digging and look through some of these charts on your own, see what ideas can emerge from that process. We need to wrap up our show and go right to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is the New York FANG Plus Index. We haven't talked about this index in a while. I realized this is something I used soon after it was released. And, we've talked about this trade, the FANG trade, the FANG man trade, a lot of names that I've seen, the MAGA trade. I mean, it's all these sort of mega cap tech consumer communication services stocks and this bundle of names that has done well. A great sort of proxy for this trade is $NYFANG. This is the New York Stock Exchange FANG Plus Index. It's not just the FANG stocks, it's other FANG-like stocks like Baidu, so has Chinese internet names. Twitter's in this, if I remember right. It's sort of a mix of 8 to 10, maybe more stocks that are in that same sort of bucket. The relative strength on this has gone vertical, so it's similar to the chart of the Qs, the NASDAQ 100, the NASDAQ Composite, the XLK, all sort of the similar theme. And just look at the acceleration to the upside. This basket of stocks was up pretty significantly, over 5% today. Chart number 2 is the Dow Jones Industrial Average. And again, this is chart A and this is chart B. And you can see why I talk about the dominance of technology. The Dow, which again is not my favorite benchmark to analyze the overall health of the stock market, but it is a good sort of cross section of different mega cap names. It has some financials, has some different stocks, not just mega cap, the FANG trade. And you can see the relative strength has just been consistently down and to the right because it's essentially underweight the mega cap tech stocks. So overall, the relative strength has continued lower. In the last week, it's made a new 12-month relative low versus the S&P. So while it's not horrible and while it's holding up okay, it's testing the 200-day moving average from below. The relative strength is telling you that those down names as a bucket are not performing as well as particular bets within there. Finally, we just want to talk about new highs. I thought it was just worth noting as I went through the breadth readings. Today we had about 37 new highs, and it's not quite updated for the close as we digest all of the charts on here. This is from Friday. We had Thursday, 37 new highs. This is the most new highs we've had since February, since the market top. So it's starting to go higher. It'll be interesting today as we lock in the closing prices. If that number goes up, I'm going to assume it does, which suggests potential for further upside. That's our show, folks. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.